Oil finally gave the market a piece of good news, but the reaction was not as clean as many traders expected. When geopolitical pressure cools down, risk assets usually get a chance to breathe, especially Bitcoin, tech stocks, and high-growth AI names. But this time, the bounce looked weak, the mood stayed cautious, and Bitcoin did not act like the market was suddenly comfortable again. That is the first warning signal, because when good news arrives and the market still looks heavy, the real problem is usually deeper than the headline. The simple version is this: oil risk may be cooling, but liquidity risk is not gone. Traders wanted to believe that lower oil pressure would mean lower inflation pressure, lower fear, and a cleaner risk-on move. Instead, the market looked more selective, more defensive, and less willing to chase the same crowded trades. At the calm metrics, this is where we stop looking only at the headline and start asking what the market is actually refusing to price in. The AI trade is the clearest example of that shift. For months, anything connected to artificial intelligence could attract capital, attention, and aggressive buying. But now the market is no longer treating every AI story the same way, because investors are starting to separate hype from infrastructure and narrative from real cash flow. That is why some AI-related names can still catch bids, while other megacap tech names begin to show cracks. This does not mean the AI story is dead. It means the market is becoming more demanding. Investors are starting to ask who owns the real infrastructure, who controls the compute, who benefits from memory and storage demand, and who is simply spending more money to stay in the race. When a crowded trade becomes expensive, the market does not need a collapse to change its tone, it only needs doubt. Bitcoin is important here because it often acts like a risk sensor before the broader market gives a clear answer. If liquidity is strong and traders are comfortable, Bitcoin usually does not need perfect news to move higher. But when Bitcoin struggles even after a relief headline, that tells us risk appetite is not fully back. It does not predict the future perfectly, but it shows us how much confidence is actually moving through the system right now. That is why the current Bitcoin reaction matters more than the price number alone. The market is not just asking whether Bitcoin can hold one level or break another level. It is asking whether fresh capital is willing to step in while the dollar stays firm, yields remain elevated, and the Federal Reserve is still not giving traders the easy green light they want. If Bitcoin cannot respond strongly when pressure is supposed to ease, then the market is telling us that liquidity is still tight. The same pressure is visible in gold, tech, and high-duration assets. A strong dollar and firm Treasury yields make it harder for speculative assets to attract aggressive buying. Gold can struggle because the dollar is stronger. AI stocks can struggle because future earnings are discounted at a higher rate. And Bitcoin can struggle because liquidity is not expanding fast enough. Different assets, same pressure point. This is why the next inflation signal matters so much. The market is waiting to see whether the data gives the Federal Reserve room to soften its tone, or whether sticky inflation keeps rates higher for longer. If inflation cools, risk assets may get another relief window. But if inflation stays uncomfortable, then the market may continue to punish crowded trades first, especially the ones that need cheap money to justify expensive prices. The mistake many traders make is thinking that one good headline automatically means the trend is safe again. Oil cooling down is good news, but it is not the same thing as liquidity returning. A market can receive relief on one side and still feel pressure from rates, the dollar, and positioning on the other side. That is exactly the kind of mixed environment where fake breakouts and weak bounces become dangerous. So the real story is not just that oil moved, or that AI stocks cracked, or that Bitcoin stayed weak. The real story is that the market is no longer reacting like everything is risk-on again. It is asking for confirmation, and until that confirmation arrives, traders should be careful about chasing the first green candle they see. The calm metrics view is simple. When the headline improves but the market does not celebrate, the signal is not relief. The signal is hesitation. This is the point to watch now. If Bitcoin starts to reclaim strength while AI leaders stabilize and yields cool down, then the market may be preparing for another risk-on attempt. But if Bitcoin keeps looking heavy while tech continues to crack, then the market is warning that the relief headline was not enough. The next move will not be decided by oil alone. It will be decided by liquidity, rates, and whether buyers are willing to step back into risk.